everyone, welcome to my YouTube channel. In this particular video, let us discuss one more problem related to the incidence of tax. So the first transaction is here. Interest on German development bonds, 2/5 received in India. So how we should analyze question is like this. Interest on German development bonds. So it is a foreign, the income is arising in foreign country. So one aspect is in foreign. Now let us check the receiving aspect. 2/5 is received in India. 2/5 is received in India. So when 2/5 is received in India, there will be two types of income. One is foreign income. Second one is Indian income. 2/5 of the money is Indian income. 3/5 of the money is foreign income. So let us solve here. So interest on German development bonds. So Indian income, it is 2/5. So 60,000 into 2/5. Foreign income, remaining part is 3/5. So remaining part will be 3/5. As it is a foreign income from other sources, only ordinary resident will be taxed. And Indian income, all three members will be taxed. Next. Income from agriculture in Bangladesh received there, but later 50,000 remitted to India. So remitted ಅನ್ನೋ word ನ ಯಾವಾಗಲೂ ignore ಮಾಡಿ. Ignore the word remitted. Do not consider that. The total income is how much? Total income is 1,81,000 and it is from the income from agriculture in Bangladesh. So income is arised in Bangladesh, received there. So its receiving aspect is also there in Bangladesh. Both the aspect, arising aspect as well as receiving aspect, both are outside India. When both are outside India, it is considered as foreign income. So it is a foreign income from other sources. Only ordinary resident will be taxed. Only ordinary resident will be taxed. Next. Income from property in Canada received outside India. Okay. So income from property in Canada. So income has arisen in Canada and income received outside India. So both arising aspect as well as receiving aspect, both are outside India. When both are outside India, we will consider it as foreign income. In brackets, some information they have given. Received, okay, sorry, rupees 76,000 is used in Canada for meeting educational expenses of Mr. X daughter in USA, and rupees 10,000 is later remitted to India. So remitted, any information given to remitted, ignore that. So do not consider remitted word in the incidence of tax. Apart from that, they have given 76,000 used for some expenses. Let him use for any expenses, that is his discretion. We are not bothered about his spending of income. We are only bothered about the income whatever he has earned. So whatever the information they have given in the bracket, just ignore that. So just keep in your mind income from property in Canada. So income has arisen in Canada and received outside India. So receiving aspect is also outside India. When both the aspects are outside India, we consider it as foreign income, and it is foreign income from other sources. So only ordinary resident will be taxed. So this is how you need to analyze. For this, there is a chart. I've explained the chart in the part 1 video. If you have not seen the part 1 video, first see the part 1 video, write down the chart and come back and watch this video. Next. Income earned from business in Kampala. Kampala is in Uganda, which is controlled from Delhi. So this is a controlled income. This is a controlled income. And rupees 15,000 is received in India. So there is two types of income. One is controlled income because business is being controlled from India. And second one, some money you are receiving in India. So it is Indian income as well as controlled income. So let us calculate. So Indian income, they have given that 15,000 received in India. So 15,000 is Indian income. And as it is an Indian income, all three residential status will be taxed. Next, remaining amount. The total amount is 65,000. In that 15,000 was received in India. The remaining 50,000 is a controlled income. And in controlled income, only the resident and not an ordinary resident will be taxed. Dividend paid by a foreign company but received in India. So Dividend paid by foreign company. Arising aspect is in foreign, but received in India. Receiving aspect is in India. But if you check the date, April 10th, 2020, it is not related to our previous year. So when it is not related to our previous year, just ignore that. So it is not related to our previous year. So you will consider it as exempted income. So that date is very, very important. When they have given certain dates, just pay attention towards that. Okay. Next. Past untaxed profit of 2017-18 brought to India in 2021-22. So again, it is a past untaxed. So when past untaxed information is given, you have to just ignore that. It is an exempted income. Any past untaxed, it is exempted. Next. Profits from a business in Madras and managed outside India. Profit from business in Madras. Madras is in India. So arising aspect is in India. So when arising aspect is in India, we consider it as Indian income. So all the three residential statuses will be taxed. Next. Profits on sale of building in India but received in India. So arising aspect is in India, receiving aspect is in Sri Lanka. So if arising aspect is in India, then straight away we can consider it as Indian income. As it is an Indian income, all the three members will be taxed. Next. Pension from a former employer in India received in Rangoon. So in India, you were working with some employer. So he is giving you a pension. Okay. So the arising aspect is in India because the employer is in India. Arising aspect is in India. Receiving aspect is in Rangoon. So arising aspect, if it is in India, we consider it as Indian income. So all the three people will be taxed. Next. Gift in foreign currency from a friend received in India on January 20, 2022. So 20th January 2022 is not related to our previous year. Our previous year starts from 1st April 2022 to 31st March 2023. So this is before our previous year. So if the information is not pertaining to our previous year, we will just ignore that information. We will write it as exempted income. So now when you add all the three columns, you will get the total income. For ordinary resident, it is 19 lakh 35,000. For not an ordinary resident, it is 16 lakh 32,000. For non-resident, it is 15 lakh 82,000. This is how you need to solve the problem. Hope you have understood how to solve the problem. In my further videos, I'll come back with some more problems related to incidence of tax.